Hello and welcome to another lesson of financial literacy. Today we are looking at methods of payment. Specifically, we are comparing cash, debit card, and credit card. And since we have talked about saving plans, as well as loans, it's great to know what your options are when it comes to spending money. So, um, for our first example, suppose you want to make each of the following purchases. First, a cup of coffee that's $4, then a new laptop that's $1,200, perhaps an online concert ticket that's $250, and an emergency car repair that's $900. So, between cash, debit card, and credit card, which of the following payments would you choose and why? And this is especially if you already know what these specifically what debit and credit cards are. But just to give you a general idea, cash is when you have physical money, debit card is money in a bank account, and credit card is when you are borrowing money from the bank. So, for a cup of coffee, of course, you can use cash or debit card. It's not a lot of money. However, for a new laptop that's $1,200, perhaps you do not have $1,200 cash in physical money that you can purchase right then and there. Maybe you have that amount saved up in your debit card, but uh, um, again, because it's a large amount, you might not. So in that case, you might be using a credit card for that option. In online concert tickets, that's $250. Again, that was not as much as $1,200. Perhaps that's something that you have saved up and you can use a debit card to pay. Another consideration would be that many event tickets, you do have to pay the amount right then and there. And the distinction between that is something, for example, programs like Afterpay or other online tools that help you make installments on your payments if you don't have that amount to pay upfront. Because credit cards, as we will see later on, there are requirements to have credit cards. You might not even have a credit card or be able or be eligible to get a credit card. So, for example, for the new laptop, you might not have that much money, and then you don't even have a credit card to be able to borrow money from the bank. However, you can perhaps have a program like, um, again, where you're making different payments, or you might be able to borrow money from someone even to pay for that. With programs like Afterpay, you do have to pay interest on it. So that's something you have to consider if you're making bigger purchases. However, with something like a event ticket, it is less likely for programs like Afterpay to fund that. You do typically have to pay the amount right then and there. So again, either a debit card or a credit card. And finally, emergency car repairs. Um, Again, that might be, especially if you're paying to like a mechanic in person, they might not have any programs where you can take or make payments over a period of time, or they might have their own loaning methods where they might charge you over a period of time, but then again charge you interest on that, but it's their own program or their own loan process. Or you might, again, because it's a bigger payment, be able to use credit cards there. So just some things to think about, especially when as you're growing up and you have more payments that you have to pay for. It is important to know how you are making payments, what your payment options are, and what the difference of each payment method is and when should you use them. So let's look at this diagram over here. So, of course, when it comes to cash and it's physical money that you're paying, so you give the cash, the purchase is complete, and the payment is complete. You don't have to worry about it anymore. The transaction is done. So that means you don't need a bank account for it. You don't have to pay any fees or interest. And um, again, yes, the transaction is complete, so that itself could be a key point or advantage there as well. However, if you are carrying cash with you, especially consider a payment for a laptop where you have to make a $1,200 payment, maybe it's not really safe to have that much money on you. Or maybe it's not really convenient. For example, if you are earning money through smaller bills and you have $1,200 saved in $5 bills, that's a lot of money to be giving to a store and again, it's not very convenient for them to count that and complete the transaction. That's not to say it's impossible. They will still, of course, accept that because it is um, a form of payment, but it's just not really convenient. And of course, for yourself, it is harder to track your spending because you might not know how much money you had and how much you spent, or if you make a small payment somewhere and then you forget about it, or you forget to track it right away, and then it gets again messy and hard to track all of your spending over a period of time. And that brings us to a debit card, which can resolve some of those issues, especially with the convenience and tracking your spending. So, with a debit card, if you have your money, you go to the bank and you um, deposit your money into a bank account. And so that money is stored in the bank, and you have a card that you can use anywhere. So, you would swipe or tap your card, and the money leaves your account immediately. And of course, the payment is complete there and the transaction is complete there as well because the money is just directly going from the bank to the store or person that you have purchased from. So transaction is done. So here you are only spending your own money. So any money that you have deposited is what you have available to spend. So you can't spend more than that because it's not available. And you will actually get insufficient errors on your card if you try to spend more than what you have. Now, with that, there's also no interest charge because it's just, again, your own money that you're spending. However, there might be an fee for the debit card itself just to have the account open. And again, we'll explore that as we go on. There are student accounts, and later on, there might be like other accounts that you can purchase. Some or many student accounts don't charge this fee from you with respect to that you are a student and maybe just to help you get into banking and to be able to have a plan for your finances without that extra hassle of paying a fee for it. Of course, it also helps with budgeting. With debit accounts, you can also have a saving or checking account within your debit card, which means that you can set aside certain money for savings and then have another smaller amount for checking, which is your daily or day-to-day spendings. And then you can track that for yourself that the money in the saving account I am not touching because I'm saving for a specific goal or just to save, just to have money because you never know. And yes, as mentioned here, your transaction, if you tap your card, it might be declined if you have insufficient funds. And finally, we get to credit cards. So with credit cards, again, you do have to apply. Credit cards are not just handed to you the same way that debit cards might be. Of course, you do have to fill out forms for both of them, but you might not always be approved for a credit card. Whereas for a debit card, they will open a bank account for you, and then it's up to you to deposit money into the account or not. But some banks or financial institutions may straight up reject your credit card application. And so let's say they do approve and you do have now a credit card. So there's no actual money on the credit card. You do have a certain limit that you can spend. And so when you tap your card, then money is being borrowed from the bank and that money goes to the merchant or whoever you're purchasing from. Then at the end of the month or sometime in the month, you receive a monthly statement of your transactions. And it is your responsibility to repay the bank by the due date, which means that you transfer money from your debit account or your checking account to your credit card to pay off your debt every month. And key points here, you are borrowing money here from the bank. So, of course, you have to be careful with that. You can't just borrow and tap your card wherever. You do have to eventually pay that money off. And you do have to pay by the due date, or else interest will be charged if your full balance is not paid. Of course, some months you may have to make a big purchase that's perhaps unexpected, and then you may not be able to pay the full amount. So pay as much as you can, and then whatever remaining balance is left, you will be charged the interest on that amount. But it's better to have or the less your final amount is, the less your interest will be as well. And of course, you are building a credit history when you are using your credit card, which can be either good or bad. If you are using your credit card responsibly, you're making your payments, then you have a good credit history. And when you apply for other credit cards, you are more likely to be approved. Or if you are asking for loans, you're more likely to be approved. However, if you are spending and not paying on time, you have a lot of interest accumulated. That can also work in the other way where you have a poor credit history, and so you will perhaps not be um, you will be denied when you apply for future credit cards. And of course, it also affects your what we'll see later on, your credit score, which can also impact if you are borrowing money or you want to take out a loan for a car purchase, for a mortgage, or any other big purchases. And of course, if you are over time not paying your credit card and that debt is building up, it you are gonna be at a risk of debt if you're not making responsible choices, and um, that can get you in trouble with the bank as well. So, of course, putting all of that together, definitely think before you pay. You have to choose the method that is safe, convenient, best for your situation, which may be different based on um, different payments that you're making. Um, so again, how big the purchase is, and or perhaps how much money you're making that month, or how much you have to spend for that month. So just some factors to consider. Safety, that could also be like, for example, if you have a debit or credit card, if you lose your card, you have to know what to do in those cases. Budgeting to know how much money do I have available to spend and what do I want to spend it on. Perhaps maybe you have $5,000 to spend on different things, but then you may choose to not spend that and save it for your future, or just save it for just because, instead of wasting your money on just random purchases. Also, when it comes to debiting credit cards or just opening up any bank accounts, there are rewards and benefits. So you might be collecting points. So those are also things to consider of which debit card is perhaps the best choice for me, or as well as the interest and fees. So different cards will have different interest rates, or even for, as I mentioned, for debit, they might have different fees, monthly fees that they charge you. So you might choose different cards based on that. And of course, always consider, if you are using credit cards, the impact on your credit score. And again, just spending responsibly and paying off your debt in time. And of course, finally, convenience. So if you have a bank card that you're spending, that can be on your phone. And yes, it's convenient that you don't have to carry cash with you, but it can also work the other way where it's too convenient that you're tapping everywhere and then maybe losing track of how much you're spending. So just something to remember, use credit wisely. Borrow today, repay tomorrow. So the quicker you repay it off, the better. Just so you don't forget it and leave it until the last minute, or you might even perhaps miss your due date if you just keep leaving it till the last minute. So try to pay off as soon as you can. And yeah, let's move on. We'll add more things as we go on through the lesson. So, of course, some key vocabulary here. Debit and credit card, I already went over, but credit limit has to do with credit cards. So, I mentioned earlier, but when you apply for the credit card, the bank will offer you a specific credit limit based on your credit history. So, typically, when you start, that might be just $1,000, or even perhaps less, depending on the bank that you sign up with. And that means that you can, at any time, borrow $500. That's not for the whole month. So if you've already borrowed $500 or you've spent $500 and your credit balance is already $500 that you have spent, then you can't really spend more, and you're going to be charged fees for it, or it might not even, the transaction might not be approved. And so even within that month, you do have to pay off that $500 if you want to be using your credit card again. Then we also have a credit score. So credit scores are part of your credit history, and they pretty much consider all your different loans, all the different cards and bank accounts that you have, and it's not limited to just one bank. It is pretty much every again, account and loan that you have. And it is a reflection of how responsibly you are using these options and how well you repay your credit. And so a lot of banks already offer this within their app where you can check your credit score, but there are also more official websites that you can apply. You do sometimes have to pay a fee for them to calculate your credit score, but sometimes it is needed for you to have that credit score. For example, if you're again applying for a loan or another credit card, they might need to know that. But typically, banks have that information on file so they can check that when they're assessing if they are approving you. But perhaps maybe it's something you want to know ahead of time if you're applying for a specific card, especially when it's a card with certain advantages that you might want. So if it's certain perks or certain point systems that they offer, then you might want to improve your credit score to be able to be eligible for those options. Then, of course, interest is going to be same thing if you're borrowing money, how much interest you're paying for it, and it is a percentage that a percentage a percentage of the amount that you have borrowed that you do have to pay off. Next is minimum payment. So with your credit card, so as you get the monthly statement for your credit card, you will see an option on it. And I do have an example for you at the end of this lesson in your practice problem that you're going to see, but it will show a minimum payment that is due. So usually that payment is really low. It's like $10, for example, which means that even if you spend $1,000 that month on your credit card, you do have to at least make a minimum payment of $10. Now, that being said, the remainder nine of the $990, you will be charged the interest on it, but for each billing cycle, you do have to keep your good standing. You do have to at least make that minimum payment. And of course, having interest accumulate on the remainder also is not a great reflection of your credit history, but not paying your cycle at all is even worse for your credit history. Outstanding balance is also going to be the total amount that you have left on your credit card that is due, or even on your loan. Specifically, for you guys, you might have student loans that will apply to you very soon as you go to perhaps university or even just I'll show you later on maybe lines of credit that you got, which are also smaller loans that you can get from banks if you are starting a business or if you are maybe even going for a vacation and you want to get a line of credit, which means you borrow a smaller amount of money from the bank, and then your outstanding balance is how much of that loan you have to pay. Then we have an APR or an annual interest rate. So for credit cards specifically, it is given, the percentage is given annually, but as we saw in our previous examples, it will be it will be looked at as compounded daily. So for each month, it will calculate if it's a 30-day month or a 31-day month, it will calculate how much interest you have to pay on the outstanding balance past your due date. So if you have not made the purchase, or sorry, if you have not repaid at the due date, then the APR will be applied. And of course, different credit cards might also have different APRs. So that might be a factor when you're looking at different credit cards to choose the best option for you of which card you go for. Then, of course, repayment is just the process of repaying back. So, if it's a credit card payment for the month, you might just repay in a single payment. Or if it's a loan, you might have scheduled payments that could be monthly, or even if you want to pay more frequently to save on some interest, you might be paying bi-weekly perhaps. But it's again the process of just repaying off your debt. And of course, debt is money that you owe to a lender, which could be a financial institution, a bank, or if you are getting OSAP, so that would be government loan money for university. So then you are paying, or it's money that, or it's the amount of the money that you have to pay, and there will be certain agreed upon terms for it. Um, Agreed upon terms for it. So how long you have to pay, the interest that you have to pay, how much the interest is compounded, how frequently the interest is compounded, and so on and so forth. Now, when it comes to credit cards, as I mentioned at the beginning, you might not even have the option of credit card because you might not be eligible for a credit card because there are requirements for it. So, as I mentioned, you do have to apply, so they do check for certain things. Specifically, these are general requirements based on Canadian banks, but for if you're applying for a credit card or you're interested to apply for a credit card, check the options that are available to you based on where you're located or just the banks that you're interested in. Typically, it is a minimum age of 18 or 19 years old, depending on the province. And when you go to apply, you do need to take identification with you. That could be a driver's license, passport, or any other identification with your name and date of birth. Um, for just the bank to check your just to be able to verify your identity. Then they might also ask for proof of employment or your income. Typically, that could be just a letter from an employer saying that you are hired with them, or a pay stub with how much you are earning biweekly or monthly. But student credit cards usually do not require this. Now, student credit cards themselves, so some banks offer this option. They do check to verify that you are a student. So that could be perhaps a transcript or typically I don't think it's just based on your student card. I think they need a little bit more information just from your college or university. But they'll guide you based on what information they need. But once they verify that you are a student, then they won't actually need this proof of employment from you because they understand that you are a student and you might not be employed at this time. That being said, you will not get necessarily all the perks of a regular credit card with a student credit card. Your limit may be lower, different interest rates, or just different benefits that are offered to you will vary. And they will also check your credit history or your credit score. Again, the banks usually have this information they can check themselves. So when you apply, they will do a background check, and based on that, they will determine if you are eligible for this credit card. And finally, for Canadian banks, they typically require Canadian residency just to make sure you are living in Canada, so you don't have a Canadian credit card and you're residing somewhere else. Now, for student credit cards, so they are designed for students that have little or no credit history. And so with these cards, usually there is a lower credit limit. It is easier to get approval because they understand that it might be your first credit card. And they have rewards for students, so some discounts you might get, or just some, or like the points that you get and the places that you're able to redeem those points might be more relatable to students. And they offer some educational tools that could be access to certain resources online, or maybe perhaps, again, just rewards for educational tools. And yes, it is typically it is the same interest as regular cards. So more for the rates, you might be comparing from bank to bank instead of from student credit cards to just regular credit cards. And just putting all of that together, why might banks offer student credit cards, do you think? So it is a great idea for banks to offer this because it is promoting financial responsibility to students from as soon as they can. They are young adults. So instead of punishing them for having no credit history, it's allowing them or giving them an opportunity to be able to build that credit history through a student credit card, which is maybe lower risk than a regular credit card. It is also, think of it as a trial period with the bank because it is a lower credit limit to see are you able to use this responsibly so that later on you can apply for better credit cards with higher limits. One thing also I'm going to add with the limits as well. So your student, if you do end up going for a student credit card, that once you're done being a student, because you do have to show you're a student every year, the bank will send you message or email asking you to verify that again. So once you are no longer a student and aren't eligible for this, the card will just automatically revert to a regular credit card. And with that, if you've had a good credit history, after a period of time, the bank will just send you offers of, we are now offering you a higher credit limit of from instead of $1,000, perhaps $2,000, and you can choose to accept or decline it at that point. And typically, it is a good idea to accept it, and I will explain with the credit score. And also, it just gives you more of an opportunity to be spending more money. But with credit score, so as mentioned, it is a score that's given to you, and I believe it ranges from 400 to 800, 900-ish. And the higher the score, the better. And again, it's just a reflection of, are you a responsible user when it comes to your loans and credit card payments? And there's no one solution of how they calculate this, but there are some factors that affect it, such as paying your bills on time, how much debt you have, and that could be any loans that you have or any debt on your credit cards. Um, the length of your credit history. So, the sooner you get your credit card, the longer period of time you will have to build your credit history. So, then they can observe you over a longer period of time. And finally, this is why I suggest that you always accept higher credit limits as long as you are using it responsibly, is because of credit utilization. So this is pretty much the percentage of available credit that you are currently using. So if you are using $500 of a $2,000 credit limit, that means your credit utilization is 25%. So, lower credit utilizations have a positive effect on your credit score, which means that if you have a higher credit limit, then for that same amount that you're spending, your credit utilization will be less. Because consider now, instead of $2,000, they offer you to raise your credit limit to $5,000, and your regular month-to-month spending is $500. Given that you don't take this opportunity as, okay, now my credit limit is $5,000, so I'm going to be spending more money, then if you continue to spend $500, now your credit utilization is only 10% because it's of the $5,000, which means that that's percentage is even lower. And especially if you're paying it back frequently, then they might reward you because you're not using that amount. You're not taking or abusing your credit limit. Now, if you do have to spend more, that's totally okay. You can always spend more, but you just repay it quickly. Um, so if you've already paid, let's say a random month, you have $1,000 emergency payment that comes up that you weren't expecting, and now you have paid $1,500. And let's say now your credit limit is still that $2,000, then $1,500 is 75% of your total credit limit. But how you can combat that is you just make a payment. Make frequent payments as soon as you can, and that percentage will decrease. But of course, 1 month is not going to change your credit score drastically. It is more of a pattern over time. So, just again, spend responsibly, make sure you pay on time, and you are tracking and watching out for your payments frequently. So now just some things to consider, and part of your task for this lesson, all of these questions that have the lines, you are required to input your own answer in your own words. I will give you some ideas, and there are some answers throughout the lesson as well, but make sure you are filling out your answers there when you submit this lesson. So one first thing to consider is missing a payment. So of course, missing a payment can result in interest charges, late fees, and a lower credit score. And so why is it important to make at least the minimum payment on time every month? Now, when it comes to making only the minimum payment, remember that keeps your account in good standing, but it still does collect interest for you. But it does give you a bit of more time to pay the interest, because then you can, if you don't have the money this month, then you have till next month to pay off the debt. So just something to consider for that. Another thing to consider is maxing out your credit card, which means that if you have $2,000, you as a credit limit, you spend that $2,000. So if you use most or all of your available credit, then you are increasing your credit utilization, and that can affect your credit score negatively, and it can make it harder to borrow money in the future. It can also be harder to repay that month as well, especially if it's not what you're typically used to paying off. So, why might using your entire credit limit be viewed as risky by lenders? Now, another thing is late fees. So, when you miss a payment due date, you may even have additional fees and interest charges. So aside from the interest charges that you were charged on your the amount that you borrowed, you may also be charged a late fee as well, which makes your debt more expensive. So how can late fees make it more difficult to pay off your credit card balance? Write your answer there. Then we have high interest debt. So if you have a high interest credit card, that means your interest is can accumulate really fast, which means that if you're not paying consistently, that interest is gonna really quickly add up, and it's going to be an amount that you can't, if you couldn't afford before, then you definitely can't afford with the interest. So why is it important to consider the interest rate before using a credit card? And finally, or no, we have a couple more. Impulse spending. So impulse spending is when you see something and you don't consider your budget and you're like, "Ooh, I want this thing and I'm gonna buy it." And especially with tapping your card these days, it makes it so easy. So it can make it really easy to buy something without thinking if you can actually afford it or not. And so, what strategies can help you avoid impulse purchases when using a credit card? And finally, you can actually have more than one credit card, but when you're applying for many credit cards, if you are applying in a short period of time, back to back, that might lower your credit score. And it can also be considered as a financial risk. And I want you to consider why might that be considered as a financial risk, and why might lenders be concerned if you're applying for too many credit cards all at once. And compare that, of course, to if you are taking over a period of time. Of course, if you get a credit card this year and then you choose to get another one next year, that's a completely different case. But if you open 5 credit cards in a month, that might be a little bit concerning. Now, here I've given you 3 different credit card options for you to consider. So we have card A, card B, card C, and with regards to the annual fee, so again, that might just be a fee that you're paying just to have that credit card open, and a lot of credit cards that have better perks might actually charge this. Now, with that, you can also see the interest rate varies here. Then we have a cashback option. So cashback option means that if you, for example, are spending money, let's say you spent $100 and there's a 1%, then that means at the end of the month, they give you $1 back for every $100 that you spend. Some other options might be 4% on specifically groceries, which means that if you, any amount that you purchase for groceries, at the end of the month, you get 4% of that back. So yes, it's a higher percentage, but it's not on all purchases as compared to this one. Or a 2% travel option. So if you are spending on plane ticket, hotels, then they give you a 2% option for that. There's also a welcome bonus option. So as I mentioned, some cards give you points that you can collect. So the welcome bonus could either be like a certain dollar amount that's given to you or points. So in this one, this is none. This is 20,000 points they give you, and this last one is $100. You might have seen this, for example, at grocery stores, specifically like Walmart might come offer you a Walmart credit card, and then they give you $25 off your purchase today if you get the credit card, which is considered that welcome bonus. Then for each of these, you have a different credit limit that is offered to you. And there's also foreign transaction fees to consider. So that means if you are, for example, traveling anytime you're outside of Canada and you spend money, they might charge you a certain fee because they have to convert the money from one currency to Canadian currency. So card A and card C have that, whereas card B does not offer that. So again, part of your task for today. I want you to consider which credit card would you consider applying for and why. And there's no one right answer here. It is just something for you to think about. Because it is based on your need of what you might need. For example, someone who travels a lot might go for this option because they get more cash back on travel, and they're maybe not really spending on groceries as much, um, even though this has a higher interest rate. Or you might just go for the lower interest rate, even though it has an annual fee. You do have to also consider how much is your general monthly payments, how much are you spending every month, and use that to compare each of these options. So in your answer, I definitely want you to consider factors related to you of what your interests are, as well as some mathematics of based on how much your monthly payments are, which option do you think is the best for you, and also with respect to what you're spending your money on. And finally, for your practice, I did want to show you, I've included, this is just a sample credit card statement, and you have all the different parts of it. It is from this website, so if you want to get more information, you can go to this link to view it yourself. But it does, again, introduce you to your credit card statement and help you familiarize yourself with the process and how to read a statement for when you are opening your own credit card. So, I hope you learned lots about your different payment options so you can make better financial decisions for yourself and just be smart about your finances. Banks always have financial advisors that can present different options to you and walk you through and give you the best advice based on your situation. So don't hesitate to consult them and ask for help. And that was the end of our lesson. And I will see you all in our next and last lesson for financial literacy, where we're going to look at mortgages. And for now, don't hesitate to reach out if you have any questions, and I'll see you all in our next class.